What's up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and we just got a triple macro collision. The Supreme Court just blew up Trump's sweeping tariff emergencies or emergency tariffs, whatever you want to call them. GDP just slowed from 4.4% to 1.4%, and the Fed's favorite inflation gauge, Core PCE, just reaccelerated. So let me ask you something. Is this bullish? Is this bearish? Or is this one of those weeks where the market stares at the data and goes, cool, now what? Because tariffs say disinflation, GDP says slowdown but not recession, and PCE says higher for longer. That's not a clean story. So today, we're going to go ahead and break this down the way that we always do. What just happened, why it matters, and how these forces collide, and most importantly, what it means for SPY, QQQ, and IWM. So let's go ahead and dive straight into it. So let's talk about the elephant in the room, the tariff bombshell. And this is a headline that I'm pretty sure nobody saw coming. The Supreme Court just struck down Trump's sweeping emergency tariffs. The ruling basically says you overstepped your authority under the emergency statute. Translation: that broad legal framework that slapped tariffs across almost all major trading partners, well, that is now gone. Now here's the part that actually matters. Penn Wharton estimates that $175 billion in tariff revenue is potentially at risk of being refunded. That's not a small number. This could affect the deficit territory. Now, an important nuance about this does not ban all tariffs necessarily. The administration can still use traditional trade laws, but those tools are much slower, narrower, and not nearly as aggressive. So the nuclear bomb just got taken away. The market angle in this, well, in the short term, this is mildly disinflationary. Tariffs are a tax on goods. Remove the tax or unwind it, and that reduces pipeline price pressure. It also improves trade optimism. Industrials, exporters, emerging markets, they breathe a little easier at night now. But here's the twist. If $175 billion in refunds actually happens, that hits fiscal math, which could mean more deficit, more borrowing, and more treasury issuance. And what does more supply do? Well, it's going to pressure yields. So even the bullish news has a macro caveat in the fine print of it. Welcome to 2026, folks. Now, let's talk growth. We just had our Q4 GDP printed, and it came in at up 1.4% annualized. That's a massive slowdown from up 4.4% in Q3. Now, before the doom crowd jumps into the comments here, this is not a recession. For all of 2025, real GDP grew by 2.6%, down from 3.1% in 2024. So what is this? Well, it's a cooling toward trend, not collapsing. Now, what exactly drove Q4? Services spending and business investment. Government spending dragged, partly from shutdown disruptions, and here's the subtle issue. The price index for gross domestic purchases ran 3.7%, and that's hotter than the Fed wants. So growth slowed, but inflation didn't cooperate. That's not the clean, soft landing script that's slow but sticky, quote unquote. And the market read on this is this GDP print does really one thing and one thing only. It keeps recession fears in check. Credit risk contained. Earnings visibility is still intact, but it does not justify rapid Fed cuts because growth isn't breaking and inflation, while it's still warm. Now we get to the actual market mover. Personal income and outlays. December 2025. And this is where things got hawkish. Headline PCE came in at 0.4% month over month and up 2.9% year over year. And that's up from 2.8%, which is above expectations, obviously. Core PCE came in at 0.4% month over month and 3% year over year, up from 2.8%, above the 2.9% consensus. This was supposed to glide smoothly towards 2%. Instead, it reaccelerated. That's the problem. because Core PCE is the Fed's scoreboard, and the scoreboard just flashed, inflation is not done. Now here's the part that matters even more. Personal income up 0.3%, disposable income is up 0.3%, nominal spending is up 0.4%, and real spending is up 0.1%, which means most of that spending growth is being eaten by inflation. And here's the kicker. Services spending surged. Goods spending fell. That's the exact composition the Fed hates. Sticky services inflation, demand driven. Consumers are still spending, but their real purchasing power is barely growing. That's a textbook setup for, well, higher for longer. So now let's go ahead and zoom out and look at this from 30,000 feet. We have three macro forces colliding. Tariff ruling is disinflation plus trade optimism. GDP slowdown is cooling but not collapsing. In PCE reacceleration, it's just sticky inflation. So what wins here? Well, SPY, broad large cap index, gets pulled in both directions. Tariff relief helps, growth still positive helps, but higher for longer rates cap multiples. Likely outcome, we're going to see a choppy index for the rest of the day. Under the hood, we're going to see some rotation happening, and value, financials, energy will be those key sectors. Everyone's going to be a little bit over high multiple tech. QQQ, this is where pressure is going to show up first. Hot core PCE equals higher yields. Higher yields equals long duration repricing. Even if tariff news helps, we basically are seeing like hardware names going to be the real beneficiary. The rate path is still going to dominate. The net bias here is cautious to bearish tilt unless yields start to cool. IWM, the small caps like the growth story, but they hate expensive borrowing, and sticky inflation means no emergency Fed pivot that can bail them out. Higher yields plus slower real spending growth is not ideal for levered balance sheets. And tariff relief is going to help goods costs, but overall, it's creating a challenging environment. So here's the bottom line out of all this. Tariffs, they give growth a small tailwind. GDP says the economy is slowing, but stable. But PCE keeps the Fed's foot on the brake, and that's a tough combo for high multiple tech, small caps, and anything trading on distant cash flows. This isn't recession panic necessarily, it's something trickier. It's slow growth plus sticky inflation. And guess what? Markets hate that more than almost anything because it compresses multiples without giving you the policy pivot. So the real question isn't, is the economy fine? The real question is, can valuations hold up in a higher for longer world? Because tariffs might fade, GDP might cool, but if core PCE stays near 3%, the Fed isn't blinking, they're not winking, and they're not farting. And guess what? Neither should you. I'm Max Pitts. This has been Trades and Gains, powered by Investor Central Club. Make sure you use that code SUPERMAX20 to get 20% off your first month over at InvestorCentralClub.com. We're hanging out over on free Wi-Fi radio for the day, so feel free to head over to Twitch and hang out with me there. And I will see you guys in the next video.